welcome to our update for the week of May 26th. We hope that you all enjoyed Memorial Day in a very safe fashion, but still honored those who certainly have given everything for all of us to at least have the opportunity to be here today. So this morning, we're going to talk about 5 different topics. I'm going to begin with a summary of COVID-19. I'm going to talk a little bit about the market update, then a little bit about the economy, about unemployment, and then looking to the future. What does the future hold? Let's start off with, states are reopening, and certainly there's a lot of uncertainty about that. The S&P 500 is merely 13% off of the February highs, which, considering that the market fell over 30%, that's quite a recovery. But what about COVID-19? Well, with limited restrictions in several states, all states have at least lifted the major restrictions. That's where we get what's going to happen. These will be uncertain times. The U.S. currently has about 1.7 million cases, and 20 to 25,000 new cases are occurring each day. Deaths are approaching, or by the time you listen to and see this recording, probably 100,000. There are more than 5.27 million cases worldwide. So certainly, COVID is not something that we can say is a thing of the past. Well, what effect has this had on markets? Well, the biggest thing is volatility. Lots of volatility remains, with more days with a 3-point swing, 3%, either up or down than we've had in the last 20 years. And since January the 3rd, 6 of the 7 best days were preceded by the worst day. So again, lots of market volatility. You can say, well, the S&P 500 is, only 8.52% down year to date. And that's a big increase. But you have to remember that the S&P has mega cap tech shares that without those mega caps, if we equal weighted all 500 stocks, we'd be down a negative 16% rather than a negative 8.5. But we have to say that 80% of the S&P 500 components are trading above their 50-day moving average. And that's the highest percentage since July 2019. Doesn't necessarily mean that we're going to visit market lows, but I think there's a lot of sentiment that we could see a 10% correction. So maybe we're not going to go back to the lows of March, but don't be surprised if we don't see another at least 10% correction. Earnings season is over for this particular quarter, and we see that there was a 13.7% decrease in the first quarter. This is the largest decrease since the third quarter of 2009. Predictions or projections for second quarter are pretty dismal, and over 50% year-over-year decrease in earnings. But on a high note, the NASDAQ is up almost 4% year to date. Many people, though, are predicting a market pullback from the current levels. There's a lot of risk in the market, and so we just need to be aware. We don't want to be chasing a rally, and that's one of the things that we're going to talk a little bit about. As for the economy and an update, well, again, predictions range from a negative 12% for second quarter by Citigroup to Morgan Stanley feeling that that negativity is going to be closer to 38%. There will definitely be a decrease in the gross national production, GDP, over second quarter, and we hope that we'll see a less significant decrease in third quarter. Now, what about U.S. spending? Well, we're spending less. It decreased by 7.5% month over month, and that is the most since 1959. If we look at credit card spending, it's decreased by 25% year over year. And remember that 2/3 of the GDP comes from U.S. consumer spending. What about manufacturing versus the service industry? Well, the PMI index, which is manufacturing, increased in May from its low of 36.1 in April to 39.8. This is slightly above what the market expected, but unfortunately, services continue to hurt more than manufacturing. Since services comprise about 77% of the US GDP, that's kind of a grim figure. So we're really posting numbers very comparative to 2008 lows. Unemployment, well, I'm sure we've all been hearing the numbers week after week. But what many employers are doing is not firing workers, but placing them on unpaid leave, giving them less hours, or furloughing them. Because the normal unemployment rate does not measure underemployment, in reality, it's providing an inaccurate indication of the job situation in the US. Many scholars believe that we have really lost about 25%, and unfortunately, about 40% of those jobs may not be coming back. So what do we see? Yes, unemployment claims are down, but still they're near historical highs. The Wall Street Journal claims that unemployment claims have peaked, but unfortunately, with 39 million unemployment claims and unemployment rate at 14.7%, that's a big number, a big number. So what does the future hold? Well, on May 11th, the Wall Street Journal predicted that we'd have a swoosh recovery as opposed to a V. The Congressional Budget Office predicts that the recovery will drag on through the end of 2021. Goldman Sachs thinks that the S&P will fall, and more than 10% over the next 3 months. It could be as much as 20%. The reasons that they feel that is that many mutual funds have underperformed since the market low. As I mentioned previously, many investors are facing pressure to chase a rally. And the infection curve really isn't flattening outside of New York City at this point. So to restart, the process is probably going to be long and rocky. Add to that the risk of higher corporate taxes if the US and China tension continues to rise. And many companies over the past few years have been doing a lot of corporate buybacks. They feel like there will be about a 50% drop in those corporate buybacks. So those are some of the reasons that this swoosh rather than a V is a bigger probability these days. So what can we do? Well, first of all, we need to know that we need to stay invested. I've mentioned previously that in studies it has been shown that If you stayed invested over a 15-year period, you would have had a 9% return, while investors who missed the best 10 days of the markets only earned 4.13%. So missing those best days can really impact your portfolio. But we really need to have a three-bucket approach, if you will. We certainly need to have some fixed income, cash, and annuities. We need to identify disruptions in the market so we can add some alpha by looking at good stocks with large balance sheets and those companies that have competitive advantages. So certainly things that are stay-at-home stocks, cloud technology, pantry products, those types of things, there is opportunity. And we always need to add that third. We need some alternatives in our portfolio to buffer against this wild volatility that we're experiencing. So what we want to say to you is we'll keep you informed. We are here working on your behalf. Our managers across the United States are diligently trying to find those opportunities while balancing the risk, not chasing things for the reason of just being invested. But folks, volatility is going to be with us. Don't get too excited when you hear those 3% swings up, because remember, after many of those upswings, we are also seeing downturns. If you have any questions, you would like to meet or consult with us, please feel free to contact Prosperity Partners Wealth Management. Let your friends and neighbors know if they need help, they need interpretation, we are here. We're learning of several large companies in the area who are giving people a voluntary opportunity to retire. That can be confusing. We do have experience in that as well. Please remember, Prosperity Partners Wealth Management is here to help and be your partner for the future.